Sometimes if you're running a marathon, you might want to stop and rest so you can finish the marathon. The biggest risk to SoFi from last year that I thought was they grow too fast. Because when you grow too fast, you don't have the infrastructure to support you. You get up to a number of different products that you're not ready for. You lose your customers and you lose your momentum.
With a very special guest, Tim Sweeney. Welcome to the SoFi Weekly. You started out with your background. Do you want to tell people you do for a living?
I was an accounting major at University of Illinois, took the CPA exam. I was about 15th out of 65,000 people. Then I taught accounting at Michigan while I went to law school. Then I was a partner in a major law firm, partner in Deloitte. I was a managing director at a wealth management firm, and then restructured a major Fortune 500 company and consulted on lots of restructurings, so a lot of tax work, a lot of corporate work, banking work earlier in my career. If everybody at $7 had bought at $4, you wouldn't have all this angst. If people lost money and they have a fear of losing more money, when you don't have a lot of money and you lose it, you don't have a lot of opportunity left. I think my regret in life was I worked too hard. I didn't have any money when I was younger. I always wanted to have enough security. And when do you think enough is enough? And so then you got in this habit of, like, in my legal career for the first 8 years, I never took a vacation. And I go, I should have taken a bunch of vacations. I didn't buy a car until I was a lawyer for 3 years. I shared a car with my wife. But some of the biggest gains you have are by sticking with your thesis. The only thing you have is your relationships with people, sharing memories. And I worked too hard and got too much money for it, but I didn't get much of anything else for that period of time in my life. Take your vacations and screw your listeners on earnings week.
What are your thoughts about why SoFi is needing to decline in lending revenue currently for this year versus what we did in 2023? What's different?
There's two aspects. There's a business perspective and the accounting perspective. The business perspective is you go from student lending, relying only on student lending, then you're relying on only personal loans. And they ramped up in 2-year time period. They ramped up by a factor of 5 or 6, up to 15 billion in personal loans. And at some point in time, you can't just be a personal loan company. You got to be a bank. And so you got to transition into being a bank. Then the accounting perspective is they had $710 million in fair values. At some point in time, those fair values, they can go on and off. Some fall off and some are added on when you keep new loans. And so if you keep going loans forever, you just keep adding up those fair values. And at the rate that they were pushing personal loans, those could be like 1.5 billion. So that's like $1.50 in fair values you have, that if you have a certain event, that's going to cause potentially $1 or $1.10 loss in any given quarter. The price of your stock and the institutions, everything, they probably have a very negative reaction. It might be a kill your company moment. So you have to figure out how to do something about that. So when I looked at this, the first quarter, they said they're reducing lending. I go, oh, I know exactly what they're doing. What they're doing is they're restricting lending so they can have better loans than they otherwise do. So they go up the FICO score, up the cash flow score, up their model. Those loans should have lesser default rates, and they should have higher premiums. And so when you sell those at the higher premiums, you can get more income from those fair values. You can use that income to offset the runoff of the other loans. And by holding them for sale, not selling them, you're not building up fair value. So you can run off those fair values over a matter of time. That gives you time this quarter or this year to be able to run most of those off. At some point, as a bank, they have to hold loans themselves, not sell all their loans. They've shown that by keeping the loans, they can get a pretty substantial NIM. In the future, what they could do is say, all right, we're going to take our best loans and we're going to hold those. Those will have low default rates. Then the second best loans, but still really good loans, will sell for premiums. You won't have the defaults because you've sold the loans. And then if you want to balance that, you can balance it off with credit default swaps or lending notes. You can avoid some of those defaults, and because the defaults are really the key in any bank. You have loans, you get return, or they default.
Another big factor, at least in the last quarter, in regards to sort of managing their numbers, was that sale of near delinquent loans. I think you had some comments about it in your article.
It's totally reasonable to do because as they're ramping up all these personal loans, even if you have an automated process, you're going to have a lot of people involved. They probably, at this age in the bank, don't have a really great workout department to be able to identify the loans and work them out. It's a thing that every bank does. Every bank has a workout department. As soon as somebody misses a payment, they'll call you. Now, they don't do it with credit cards because they don't really care that much about credit cards because they're charging 28% interest. But for personal loans and stuff, they can work that out. They can sell them before they come default. It's fine to do that. And it's not in defaults. There's a lot of things you can do to avoid defaults. You're going to skip a couple months. Why don't we modify the loan? We'll lower the interest rate a little bit. We'll stretch it out. You do whatever you can to avoid default, because a default, you lose lose all the principal at default, because once somebody defaults, they're never going to answer the phone again. They're not going to pay it. So you got to work with them.
Whenever you were talking about SoFi transitioning to even higher credit underwriting, getting better and better clients, would that not potentially slow down or impact their coupon rates of their average loans, because potentially they would give out better rates to people who essentially deserve them?
The farther you go up the credit, say FICO scores, but it's more than FICO scores. The farther you go up that, the less likely you're going to get personal loans. I have 850 credit. I'm not getting a personal loan. I have a credit card with Citibank that I can get a 1-year personal loan at 5%. You pay it up front, you pay 5% later, it's 5% loan. So they're going to have to compete with products like that. There's ways they can do it, but there is more volume there that you can get by slightly restricted at first, then you go down a little bit, you ease some of that restriction to get to the number you want, to what you can sell. At some point, you'll be able to sell them at a lesser premium, but you'll still have more premiums. It's a balancing factor between how many loans you're going to sell at what premiums. You want to sell one loan at 7%, or you can sell 20 loans at 6%. So you can walk it down and figure out what you do. They do a really good job of managing their numbers. They really do.
Tim, I'm curious, in the lending segment, because that's the segment that is giving a lot of people pause right now. How do you think about that as we go potentially to have a rate cut towards the end of the year? Do you think that's going to be down or closer to flat, or maybe even up single digits? And that breakdown in terms of personal loans and student loans and home loans, that mix in terms of the originations and in terms of the actual revenue for lending, like how are you thinking about that relative to what they've guided for?
Their guides are really conservative. The guide for the first quarter was similar to the guide for the second quarter. And what they came in the first quarter is similar to what the market had proposed or suggested they would have for the second quarter. So I'm not worried about them not coming in the numbers, because they can just go up and down a little bit on their credit quality and ramp up those loans. I don't think the Fed can afford to raise rates. I think the Fed at 3% can't lose their momentum in this and just start raising rates again, because that's going to be a disaster for everybody. Commercial loans, office loans, especially in some regional banks. But towards the end of the year, they have this opportunity now. So they can run off these loans and still do higher coupon loans right now. Instead of 14.5, if they go up the stream and they get 14 or 13, that 1% is not going to be that material. The lower they get that, it takes the probability of a disaster off the table. They're turning that from 718 down to 600 and some million in the first quarter. Shows you something. The other thing it shows you is if they can run off those and have write-offs of 100 million, which is about 10 cents a share, and still report 2 cents in earnings, that's 12 cents a share. So if they do that the whole year and they report 10 cents a share, that's really effectively 50 cents a share on an ongoing basis. If you look at Noto's background in some of the speech he gives when he played football, he says, you always play defense. You always play defense. You can beat a better team by better defense because you keep their offense in the field too long, and then you can do it. And then you know when to ramp up offense. Take him for his word on that, and that's what he's doing. He's playing a little defense here. He's going to not run personal loans up to 18 billion. If they do, what I think they would do is run off these fair value loans. What do you have at the end of the year if he runs them down to 100 million? Where's the bear thesis then? The defaults? Because if they're ran off, you still have defaults. In a declining interest rate environment, it's a complete advantage. They can have some stability while they're running these off. And then when loans start refinancing, if they refinance through SoFi, they could modify the loan. They could take some of the loans in 1 month, slow it down, the refinancings, because some people naturally will wait for the second fall in rates to refinance. So if they go slow enough, that's an advantage to them. If they go really, really fast and they had 6 rate cuts, you could have so many people refinancing and they're not charging a fee for the refinance. And every time somebody refinances, their prior loan and all that fair value gets written off. So that's not a profitable incentive to do. So what do? You slow it down. You're not adding on additional fair value, but you're subtracting fair value. And to do that, you have to have more income. To have more income, you have to go less defaults. It's going to help your fair values in your inventory, and you're going to create more income to offset what are those fair value runoffs.
Let's say that they start cutting rates, and it's the worst case scenario. We don't have a soft landing. They're cutting rates because of a faltering economy. Things are falling to pieces. As far as them basically a mix shift that they're moving from the type of loans, from the personal loans to more of the refinancing side, are those considered safer as far as default risk, or is there an advantage of that sort? Or why would it be more desirous as SoFi moves from just a personal loan refinance company to a bank?
The switch in loan type is probably not really called a switch, because you're just going to refinance a personal loan into another personal loan. But you have an advantage, because when rates fall, you do have an advantage that your existing loan book that has low default rates is worth a ton more. It's just kind of a balancing approach of like how fast rates go up. People will start buying those loans hand over fist at higher values because interest rates are going down. As the interest rates go down faster, you'll find that their existing loan book goes up further. Now you might offset that because you might have additional default. So like I said, it's a balancing test. You don't know what it's going to be. You manage your defaults, you sell some of your loan book to increase your thing, and you refinance those loans in the manner that you don't create additional fair values, and you're pretty well set, but you're probably going to take that 92 to 95%. I think it's going to be more like 100%, especially in that environment. That might hit even more. At that point in time, you just ramp it up because you're going to get a lot of customers and new members from other people. You're going to have a little special refinancing. You're going to have another customer acquisition cost will go down because people are just coming to you without you having to spend a lot more money. You'll spend some marketing spend. Who knows, if you get into a recession, you go farther, you take something good, it's good for a while, and then you take it farther, then it can be bad, right? Because then your defaults can rise later. The job of a bank is to manage their loan, manage your defaults, then originate new loans. So you got one half is originating loans, the other half is managing those loans.
Doomsday versus best case scenario for rates, just to understand your opinion here. So any sort of rise in interest rates, bad news for SoFi.
They could get around some of it. Any kind of huge swing up is really detrimental for them.
But then also in your article, a massive swing downwards in rates could also be very impactful as well on a negative direction.
Yeah, because number one is everybody is going to want to pay off their loans with new loans. So that can cause problems. You can offset that with the loans you have become more valuable. But then again, you're offsetting it. You're not creating more EBITDA and more capital ratio. And you're going to have a lot more demand for other loans that you need that capital ratio for. So that's the balancing factor, right?
So a slow drip off of rates is the perfect scenario for SoFi.
In my mind, yeah. Towards the end of the year, November, December, rates starting fall. That gets them through what they need to do on a stable playing field. You know what's kind of going to happen. And then the anticipation of those lower rates is going to help them sell their loans. Say they have in their model that they're going to have X amount of loans at X rate, and they're not getting enough loans, but they're getting good in principal, and the defaults are staying okay. They're just going to ratchet it down a little bit. They're going to turn on the faucet, let more credit out. It's not like they're stuck one way or another in their model. That's what people don't understand. It's like when you're in management of a large company, every day you're managing. It's a tough thing to manage. So you can't really expect like, okay, well, where is the business accounts? Where is the new credit card? Where is the custodial accounts? Where's the retirement accounts? That stuff, it all takes time and they'll get there. But people are in a hurry because they've lost money. It's a common thing.
Do you think that lending is going to decrease in revenue this year, or do you think that we'll come out still slightly above?
Whenever, like you're going up in credit quality and trying to get more loans, it's going to be a learning phase. I don't know how much they learned in the first quarter. If they learned a lot in the first quarter, they might have a slower second quarter, but I think they'll learn through the second quarter. It depends on what happens with the Fed, depends on what happens with interest rates, but if it stays the same, it looks like they're going to cut now in 2 or 3 months. There's going to be an exceedingly higher demand for their loans at certain rates because they want to pre-buy those loans before the rates go down and the prices of those loans go up. And when they do that, they have to have a lot of capital ratio space to do that because they want to issue way more loans and sell way more loans. So then it's like, do we sell all our loans or do we sell some of our loans? Because then the value of the loans goes up the longer you hold it. They're in the reverse situation that they were when the rates went up. They'll be able to sell their book. They'll have increased fair values. They'll be able to knock off the fair values in their inventory by selling them and actually achieving them when they wouldn't otherwise achieve them.
Can we get Tim's thoughts on interest rates dropping while SoFi holds APYs at 4.6%?
My personal viewpoint is they'll hold them up longer than other people. They can afford to keep it up with their inventory of loans that will be increasing in value. That means the value of the loans goes up. But as the spreads for new loans go down from 14% to 12 to 30, say it goes down to 6, you can't keep it at 4.6%. They'll keep it up for a while because as rates fall, they'll have an advantage. On our private chat with Chris Hager, I was talking about where we thought the stock would be after the earnings. And I said, after the earnings, I think it's going to go as high as 820. And then I said, it's going to go down between 7 and 9. I said, it might stay there for a longer period of time because of what they're doing. So I'm not that concerned about stock price. If it's $7 to $9, it's $8 in July, I'll buy more than $8. I'll buy more at $9. I'll really ramp up my purchases if something happens and it goes to $14, because then you're going to have a lot more institutional buying at that point in time. As irritating as some of the bears' thesis was to me, it's also, you have people say, it's a 5-year investment, and then when they don't hit their numbers and the stock falls $1, they're like, oh my God, I got to get out of this. Everything I put in that article, the shorts know, but they're just counting the other people don't know. At some point in time, that'll turn. You'll see the gradual reduction of the short interest. The short interest from the delta hedging, they're not going to cover that. They keep it open. They've got themselves covered by the conversion. The money that they're shorting, they're using other places to make an additional interest return. The total short interest is a little bit off. It's not as high as you think it would be for actual shorts. You'll see it bleed off 180 million to 160, then 150. You want to look for that at the same time that institutional ownership rises, because that means that they're turning.
Do you think that there is going to be an inflection point from the stock perspective where you're just going to see a quarter where it just jumps and then you sort of have capitulation on the short side? Or is it just going to be a stair step gradually upwards each quarter?
I think the overhang will always be the fair value accounting. And when the shorts realize that the fair value accounting and inventory is going down and the defaults are staying steady, at that point they lost. The question is, what's the macro environment? You can never say what it will be unless you tell me what the macro environment is.
In our DMs, when we were chatting about this, you were saying that you were seeing some angst by retail investors. And I saw it too after the Q1 earnings report. Based on the stock price falling, people are very short-term oriented. Their emotions fluctuate based on the stock is red or green on any given day. But you also said there's a bunch of misinformation out there, and that's also what led in part to your post. What is the main thing that you think people get wrong or are misinformed about SoFi that you sort of want to call out?
The first thing that got me to write the post was all the different bear theses, like the discount rate. The discount rate was in November, where people said you can't have a discount rate close to the Fed rate. But generally, the way you do it, the discount rate is you use a higher discount rate if you're using the 14% loans and you're not subtracting for cost of capital and you're not subtracting for defaults, because that benchmark index will include that based on the averages. You don't want to use the averages because you're above average. So it's like if I get a credit card that says the average guy does this, I go, no, I'm above average. What they do is they take the returns and they subtract the cost of capital, they subtract the defaults, and you're getting a risk-adjusted return then. That risk-adjusted return is basically close to a Fed rate. You just have execution risk on that. And then the next thing that came up was the capital ratios. So in November, people said they're going to run out of capital. There's no way to give them capital. They have to do this. And I said they could just buy back all the convertible loans at a 30% discount and create up $2.4 billion of space. They can do other capital maneuvers. It's not that bad. And then it goes to the fair value accounting. If you take the same loan, say you have a $100 million loan, and it's 5% defaults, and there's a 4% premium. Under fair value, one's 104 and one's 95. Over the term of that loan, it's exactly the same to the bank. What do you think it is each year in cash flow? It's exactly the same cash flow. That's why when private equity guys buy companies, they do cash flow analysis. They don't use financial statements. They take stuff from financial statements, but they always do their own discounted cash flows based on what their own assumptions are, garnering information out of the financials. They keep coming up with these bare theses. They're just flat out wrong. So I just wanted to do a post that kind of debunked all the bad things and got back right to the point where people could understand what their risk is. The risk is always a default risk. The risk is always a growth risk. Are they growing? Yes, they're doing a good job growing. Are they managing defaults? Yes, they are.
Yeah, look, I think the accounting methodology is a very easy thing that people rely on for a bear case because it's always hidden behind this veil of complexity that the average retail investor can't really penetrate or understand. And the fair value accounting has been criticized in large part, and also the fact that they don't report certain numbers the same way that other banks report certain numbers. And so automatically the assumption goes that there's something that's not right there, or it's always a negative sort of connotation.
It's kind of a misunderstanding of the fair value accounting. It's kind of a legitimate criticism of the fair value accounting. And it's also kind of some laziness in analysts because they don't understand it. So the bear thesis is you're recognizing income faster than you can. But then after the next year of the loan, you're recognizing the losses faster than you can. Their thesis is you got to keep ramping up those loans to cover the losses that are running off it because you're putting them in the beginning. And that's kind of a fair comment, except for the fact that SoFi did their best in that situation to grow their loans in a very difficult environment. They did all the right capital restructuring, in my opinion. I think one of the concerns people go, oh, we're going to be diluted, we're going to be diluted. But when you do a stock split, you get your number of shares diluted. That's generally a good thing. When you do a reverse stock split, you get accretion in your shares, and that's generally considered a bad thing. Dilution in number of shares doesn't mean anything. You get dilution with the 2029 notes, you might get some potential dilution, and they cover it with a capped call. But where you don't get dilution is the stock stays in the same place. You really care about 10% dilution if your stock goes from 10 to 40? No, because then they use the money from that dilution or whatever they did got from that dilution to effectively grow their EPS for everybody. But where you're worried about dilution is what if it stays for 7? Well, then you're going to get no dilution. Yeah. So you're actually protected in dilution in the downside.
It's emphasized as a criticism because of what the stock price has done, where people say, say, okay, well, if I bought SoFi at 7 and they had a certain share count, they're still at 7 3 years later, and that share count is maybe 10% more, then all of a sudden they care more about it. Because if we were sitting at $20 right now, literally nobody would care about the dilution.
That's a legitimate thing. I mean, it depends on how much of your money you're investing and how much is it in there. I mean, if it was like 0.1% of your portfolio, you wouldn't care about dilution. But there are a lot of people that I think jumped on the I'm going to get rich bandwagon and it's going to go up rapidly. Why aren't they doing business banking and a new credit card and all this at the same time? You can't do all this stuff at once. A lot of retail shareholders, that money was hard fought for them to save, and they're not gaining anything. And they say, I could be in this, or I could be in that, or I could be in NVIDIA. Like some of the bears say, you have this opportunity cost, you're missing the opportunity cost. But if you bought the stock for 10 and you sold it at 7, you take a 30% loss. To get it back up to 10, you're going to have a 46% gain. What stock are you going to invest in that's going to give you a 46% gain in 1 or 2 years? Then you ask yourself, do you really think that SoFi in 3 years is not going to be $11 stock? You know, when I was managing director of this wealth management company and we were talking to people with billions of dollars, a lot of them were gamblers. And what we just came up with, what a lot of wealth management people use now is you take a third of your money and set it aside and treasure something really safe to provide for all your living expenses the rest of your life. Then the second tranche, you get like stocks, index funds, something that's safe that's going to grow, throw in a couple of risky things here and there. And that third takes care of your kids' lives. Then the next third, you do private equity or something to get really outsized returns. It's kind of hard to do it when you've got like $10,000. Say I'm going to do 3,000, 3,000, 3,000. But if you only have 10,000, you probably shouldn't put your own 10,000 into SoFi. You're gambling at that point because you need the money. And if you need the money, you're going to have to get out at the most inopportune times. And most people get out when they lost money because they're afraid of further losses. The SoFi business model is a disruptive model because banks can't compete. Theory is that's what everybody said about Amazon. It's just a bookseller. It's just another bookseller. They're just another bookseller. But my thesis is even if they didn't have the tech, they could be very successful as a bank. The one thing they need to be very successful as a bank is a better credit card. Because what do all banks have? They have savings, deposits, and credit cards. So I would concentrate on that. It'd be my next one. Why? You say, well, it's a loss. You want to get rid of the loss. No, because when you turn around a loss to profit, you get like a double gain. So they need to come up with a better credit card. And they need to come up with something that fits their company. The company is get your money right. You can't get your money right paying 28% interest on a credit card. They have a huge opportunity that banks can't match by tying a credit card to a number of different things. You can develop a credit card that pays a lot, that people pay a lot less interest. Because when you get to somebody at the upper levels, 160, 180, 200, they're just not going to carry balances on their credit card, so it won't be profitable. But if they carried some balances and they paid 10%, it would be profitable, more profitable. And I think that's the problem they're running into right now. The quality of their people that are using the credit card, they're just paying it off. They're not carrying balances. And then the lower level credit people are carrying balances and defaulting, and the interest doesn't catch up. That's what would be my best guess. Say they developed a credit card that was a 10 or 12% interest, and they could figure out how to do it, which there's a way to do it. How many members do you think you get from that? Tie it with a savings vault for lower income people and have it be a secured credit card. No, and you would have no defaults. It's just how you structure it. When I was working, I had a ton of income. I was managing my income, so I basically didn't work for a year and didn't have any income. So I went to refinance my mortgage, which I've never missed a payment, with Citibank. And they said, well, you're not a good credit risk. They said, well, we'll give you a loan, but your rate is about 7%, but we'll give it to you at 9.5% or 10%. I go, if I'm not a good credit risk at 7, what kind of credit risk am I at 9? And that's typical for banks. They don't realize that of course you can't pay your student loans down when they're 11 or 12% interest rate, but if you put them at 3%, you probably get more of them paid off. And so you got to balance that between losses. And credit card companies and banks traditionally like the higher interest rates in the balances because it throws in money into their accounts and they worry about the defaults later. That's why, so many people in credit cards, they just write them off. I'm not paying my credit card, and then they're never going to go after me. And then, 2 years later, a year and a half later, they sold some collection agency and maybe you collect it, maybe they don't. They don't care because they're getting those high 28% returns, but that's not consistent with getting your money right.
I know that there are some credit cards that'll hold 15, 18% APR, and then some of the other ones are 28, 29%. I'd be interested to see what the defaults are versus the different APRs, because even whenever I go to get credit card, I never even look. I never plan on holding a balance. It's just the benefits to the user that I care about. So
right. You don't make the bank any money either.
The average person looks way more closely at whatever the credit card perks are than at the APRs.
Right. But I think there's a big place to use credit cards with lesser interest rates. There's a lot of things they can do with credit cards. They got to think a little bit outside the box. They need to turn that around.
They kind of have a system built in already where if you run up your credit card debt so high at 28%, you're probably getting a push notification from them saying, hey, you want a personal loan? loan, we'll wipe that away pretty quickly.
I thought about that earlier. It's kind of a good setup to sell personal loans. The question is not to keep your members. You want to keep your members happy, but you also want to keep potential new members happy. You want to get new members. In my mind, it's all about the new members. The new members bring more deposits. You got to determine what products fulfill that demand.
Credit cards were scarcely mentioned for at least 3 earnings, if not 4, and then a whole lot about credit cards. So
Yeah.
You do have to be careful with credit cards in an environment if interest rates are going up or if you're getting a recession. So you have a sweet spot within those two. So it's not an easy thing for them to sort out. I mean, this Robinhood, for example, their credit cards like, okay, well, yeah, they got billions of dollars in. They paid like 125 million. They're going to allocate it over 30 years or whatever they're going to do. When you condition your customers to always get things rather than have stickiness, right? If you condition your customers like wait to put more deposits in until I get another 1% or 2% bonus, or do you want to give them services that they really can't live without that every month they need? I'll go to Robinhood and take my retirement account. I'll let it sit there, my account, and I'll get the 3% bonus. I don't know, how that affects them because I'm not going to do anything in it. Buying customers leads to buying customers.
What are your expectations for growth over these next 2-3 years? You said you're a 5-year plus investor of this company and you'll play it as it goes, but what are your expectations long term?
SoFi, in my mind, when I first started here, was get your money right. We're going to high net worth young individuals that are making a lot of money, and we want to give them like the same advantages as wealth management. SoFi will take off when they fulfill that promise. Because to get into wealth management, they have a minimum of like 10 million, 20 million. There is a great opportunity for SoFi to fulfill that promise. If you have a $50 million client, and for tax purposes, they don't sell their securities. They might issue some puts, they'll get some interest income, and they'll just borrow from the investment bank. And they ain't borrowing at 10%, they ain't borrowing at 28%. They're borrowing at like a couple percent, 3%, 4%.
Sure.
And the reason investment banks do that is because they're making a 1%, 0.5% management fee on their $100 million. You try to mimic that system. And how do you mimic that system? Well, you got to have like what they're trying to develop is various investment categories like their automated investment wealth management, which will then include retirement accounts, will then include custodials. Something that Steve mentions in the show a lot. He's right. It's farther away. You can't just do that quickly, all right? But if you develop that, once they develop and you see that they're developing those core things to do that, then the guy that makes 150,000 this year, in 5 years he's making 300,000 or 200,000, and his wife's making 200,000. They need their checking account to be like Quicken. They need like a Quicken formula to set up everything, payments on them, and all the checks get issued or transferred electronically by them, like a wealth management person does. They get a report every month that says, here's where you spent your money, so they can check it. They get bill pay services, money management services, they get investment services. That is what I think Noto means by the one-stop shop for his target market. And once they get to that, it's an extreme growth because you not only get the management fees, you get the custodial fees, you get the retirement fees. The better credit card is actually, in my mind, the start of that. You need a better credit card, and you could charge, say, $250 for that credit card if it was like 8% interest, and you only give it to people who are never going to default. And so if you don't have any defaults, you're making an 8% return, plus you're making $250 a year, depending on what their credit limit is. I think I put in one of my tweets, I said, what do you do when there's 20 million members? And they come up with a credit card that they make $40 a year on, $1.60 a share just on that. Then what's the value of that company by itself? Then you get a couple tech wins in the next 2 or 3 years. They have to build this and give time for their tech stuff to grow. That's the garden you have to water over and over. Sometimes when they say, we'll let you know we're in the RFP process, I'm like going, RFP process? You know how far away you are when you're in the RFP process? There's all this stuff you have to do. It isn't done in a year. It's not like tomorrow we're going to sign up Bank of America and start getting paid. That doesn't work that way.
Even for Galileo, right? Even after implementation, revenue can still be delayed. They can slowly start to port over new cards only or something like this. It's actually much longer.
But when you're selling software as a service, typically those deals are 10 or 15 years. So if you break even in the first year, you lose money in the first year, you're going to have very high margin sales every year thereafter.
How likely does Tim think that SoFi may get bought out? And if you want to also add, but I don't know if it's important, who are the likely buyers?
I don't think it's that likely. I used to think when I was in college, a lot of these large companies, look how well run they are to be so big. And then after practicing consulting for a long period of time, I go, look how big these companies are that are run by idiots. The problem with the big banks buying out SoFi is their egos won't let them do it. The guys that are really smart, like the Jamie Dimons of the world, who's the only person I'm mentioning because he's really smart. Is he a buyout candidate? He probably thinks he can do it himself. They're really small compared to like a lot of the big banks. And so that's actually good. You're not a target, but they're very well aware how many branches Wells Fargo's closing. Wells Fargo's laying off a ton of people. Bank of America's laying off people. Bank of America's closing tons of branches. Being a disruptor is working. The problem for SoFi when you're a disruptor in the banking industry is you're disrupting the industry where your stock price gets affected because you're part of that industry. You're disrupting your own industry, so it hurts you too, even though you don't have any commercial loans or you don't have the same problem that SVB does. I wouldn't want them to get bought out because my scenario is like in 10 years, maybe that stock's significantly over 100 if they do it right. If they do it wrong, it could be 30. Like somebody says, I want to be bought out for $12. I go, okay, well, I make a bunch of money if it's $12, but I'm not making what I think I can make otherwise. The biggest thing you are when you start a company, in venture capital, you don't want to give away the whole company because you're not going to then share in the upside of your ideas. I think Jamie Dimon is probably the only one that probably realizes SoFi's competition might be good for his bank too. If SoFi takes away a lot of Wells Fargo customers before they take away Jamie Dimon's customers, is that not good for Jamie Dimon?
All right. Thank you all so much for watching, and bye for now.